Welcome back. Another big day for equities. Let's get a check on commodities. Bob Iaccino of TopstepTrader in the pits at the CME Group. Hello, Bob.
How are you, Maria?
Good. What's going on today?
For more on the markets, let's head right to the trading floor in Chicago, where we are joined by Bob Iaccino, Chief Market Strategist at TopstepTrader.
I need to get to Bob Iaccino, who's always good for a major proclamation or some type of pronouncement about the markets. Go, Bob.
Well, it certainly is Europe. And the thing about risk is it's funny. There's two ways to look at risk. What are the risks that are out there, and how much risk am I going to take? And that's always what I'm addressing when I'm speaking. How much risk am I taking? I know how much I can stomach.
Bob, what's the news out of Chicago today?
Well, we're obviously watching crude oil as well as the entire energy sector. These sanctions between Russia, the EU, and the U.S., they do matter, especially to crude oil traders. There is going to be renewed concerns about supply disruption and some of the pushback from Russia with these sanctions. Coming up in the business for the last 21, 22 years, a correction is 8 to 10%. And then I need to see basing action of the equity markets at that point. I want my correction, and I'm not going to get fully invested into the market until I get it. It is needed. It's needed for higher highs to happen over the course of Q3 and Q4. So I think it's going to happen, and there's going to be a few volatile swings on the way there. If Europe implodes, the U.S. dollar, and to a certain degree the yen, will be spendable. The euro will not. And you still have a way to liquidate your gold, but they'll give you dollars in exchange for that. I really believe we've turned the corner on interest rates, meaning the 10-year and the 30-year rate sector is going to go higher. And I really think that happened on Friday, both technically and fundamentally. So that concerns me a little bit for the housing sector, for the stocks that react to the housing sector. So I think with this sort of earnings multiple rally that we've had, especially last year, it's going to become a little bit worrisome over the next few weeks.
What we do a really bad job at here is explaining to people risk-adjusted returns. You can't just look at how much something is up. You have to look at how much is at risk when you're getting that. If I can get another 2-3% in the S&P, but I'm risking 8 to 10%, not a good trade. I'm willing to give up some upside in the short term to not take this risk.
Good advice. He's one of the best teachers out there. And such thanks to all of you guys.